Hello, everyone, and welcome to a market update. It is Tuesday, the 6th of December. We are now in the final stretch towards the end of the year. Looking forward to Christmas break. I certainly am. I hope you are too. But we've got a lot of market action to come before we get to the eventual Christmas break. Just a quick housekeeping note, we will be closing our office on the 23rd of December, probably have a half day that day, and reopening around the 6th of January. We will have people checking emails and stuff during that period of time, but hopefully we can all have a nice break and not have to worry about doing anything during that time, but just be aware that during that time, so 23rd of December through to 6th of Jan, we might be a little bit slow in coming back to you if you do have any queries regarding accounts and so forth. Top three things today are going to be interest rates. We've just had the RBA announcement literally about half an hour ago. I'm going to talk a little bit about the economy, the global economy, and the local economy. And then finally talk about the U.S. dollar, because there's a lot of interesting stuff going on right now. And I think we're being set up perfectly at the moment for a continued bear market into the new year. And I'm just going to talk a little bit about that. But let's hit interest rates first. Something that I just as a high level that I'll mention quickly is I'm reading a book called The Tao of Capital. This is a great book. It's hopefully coming up the right way around on your screen. But anyway, The Tao of Capital. Mark Spitznagel, I believe, is the Mark Spitznagel is the author's name. Very interesting book around, and I'll talk probably a little bit more about it in the economy section. But it's really a book about Austrian economics and the way you view the markets from an Austrian economics perspective. Now, if you haven't ever heard of the Austrian School of Economics, there's a big reason for that. The Keynesians, who you've probably heard of, basically took over, wrote the rule book with John Maynard Keynes back in the early part of the last century, and that has been the economic Bible, I guess, if you will, that has been taught in U.S. universities and around the world, for that matter, for the better part of 100 years. And it's not the only school of economic thought. The basic difference between the two is the Keynesians believe that government should step in to try to help markets regulate the business cycle, etc., with money printing, more or less, when things go bad. And that has been what they've done over the course of the last 100 or so years whenever there's big economic calamities. Now, one of the few times where the central bank probably didn't step in to do that was when Paul Volcker was chair. And I'm trying to remember the exact dates, but that was when we had that big run-up in interest rates as he was trying to quell, Paul Volcker, that is, was trying to quell the huge amount of inflation that we had in the system at that point. And then now, which is Jerome Powell, who is signaling, that he's maybe the second coming of Paul Volcker. Who knows? I'm giving you a bit of that background because for any of you who are interested in Austrian economics and a bit of a history on that, pick up The Tao of Capital. Very interesting read. The first portion of the book, about three-quarters of it, is a bit of a history of Austrian investing and how that school came about. It's an interesting read, and then the back half of it is probably quarter of the book is more about applying the Austrian School of Economics to investing. And I'm going to actually show you an index called if you've heard of Ludwig von Mises, it's the Misesian Index. Hopefully I've said that right, but I'll get to that in a moment. But let's talk about rates. So the Australian Central Bank has raised the cash rate now to, let's see here, 3.1%. And they're citing, of course, inflation, which we know is too high. We've been talking about inflation, or I have been talking about inflation in these market updates now for quite a while. And inflation is still in Australia and globally, for that matter, too high. So the central banks are going to continue to have to deal with inflation to try to bring that back to a level that is, in their mind, no level of inflation is really a good thing, or any level of inflation is not a good thing. It's a bad thing. It's actually something that erodes our purchasing power. So we actually, as a consumer, as a person earning money, earning a wage, We want to see deflation because it means we can buy more with what we are earning. Inflation means we're buying less with what we're earning, which is why you're probably hearing stories about increasing minimum wage and collective bargaining reviews, people going on strike, trying to increase pay, this sort of thing. And also there's a gap between the inflation rate right now and the rate of pay increase. So effectively, we're going backwards as an economy and as individuals because we're not earning the rate of inflation. At least I dare say most of us are not earning the rate of inflation. So that's just a little bit of an economics lesson, I guess. And I guess the point I'm trying to make here is that the RBA, whilst they have slowed the pace from 50 basis point increments to 25, they still haven't signaled that they're going to either stop raising rates or begin cutting rates. Now, they will eventually get to that point, and that's not going to be, I don't think anyway, until sometime middle of next year. I think we're in for a very interesting period over Christmas. I have a feeling that the retail in the Christmas period, retail data will probably be pretty good for Australia. We've seen a lot of people, as I've mentioned before, taking out credit and credit facilities. That still seems to be prevalent, the point of sale credit and people applying for credit cards and so forth. But those chickens have got to come home to roost at some point. But we have a big event coming up the middle of next year. It hasn't hit our economy yet, but it's going to start in June. It'll probably start a little earlier, but the big chunk of it's going to happen in June, July of 2023, and that's mortgage resets. So a lot of people took out, myself included, and many of you did as well. Many of you who are my mortgage clients took out 2 and 3 year fixed rates at exceptionally good rates. So they have a 2 in front of them, most of them. Some of them have a 1 in front of them. And those mortgage rates are going to reset to something in the mid 5s, maybe high 4s, mid 5s range with this most recent rate rise. And that's going to represent a huge increase in interest payments that are required on outstanding debt. And it's going to impact the disposable income of a lot of Australians, which means that they will not be able to go out and spend as much. They won't have as much disposable income because they'll be spending more of their monthly incomes on housing. And I think this is going to have a real big impact on the economy. It's going to take time to have that impact, but it will have an impact, and we may start seeing that as early as maybe March or April of next year. We just have to watch the data, but it is going to happen. And if the RBA doesn't get some positive relief from inflation numbers in the next couple of months, then they're going to have to continue raising interest rates. All of this leads me to say what I'm about to say, and that is the cost of capital has gone up by a huge amount. Here is a chart of official interest rates in Australia since probably about 1992. Yeah, there you go, 92. And as you can see here from 93, 92, 93, we probably had an average rate and through to about 2008, 2007, 8, we probably had an average rate of around 5%. That was the RBA official cash rate. I remember when I got started in the mortgage business, a standard interest rate was between 4 and 6%. That's the kind of interest rates that were available to home buyers and property investors. And since the global financial crisis, we've kind of been in emergency rate mode, and they tried to get them back up in 11 and 12 there, but then we've just had this precipitous fall all the way down to the COVID crisis and everything else, where we effectively were at zero cost of capital. The cost of capital would have been practically zero, even though interest rates at that time for a variable rate mortgage were 2 point something percent. Around that time, inflation I think was running at 2 point something percent. So really, if you look at it that way, the cost of capital was practically zero. To now, this almost hockey stick like ramp in rates where the official cash rate now has got a 3 in front of it, and that's happened in a very, very short space of time. And as you can see, from this chart, a lot of these moves take, I suppose except for this move here in 1994, 95, a lot of these moves do happen over periods of time, months and maybe even a year to 18 months. This is a great example here from after the tech bubble burst and we had these exceptionally low rates by Australian standards, we went on kind of a rate rising cycle of about 4 years. So it begs the question, how long are we going to have elevated interest rates? That's the first question. I don't know the answer to that. No one does. The second question is, when the Fed in the US and the Australian Central Bank pivot and begin to cut rates, how much are they going to cut? And to what level are they going to cut? Are we going to go back here to zero? I seriously doubt that. I seriously doubt that. Where will we go back to? Will we go back to 2% as a cash rate, 2.5%? The answer to that is I don't know. And no one really knows, I think, until we get there. There's going to be a lot of moving parts and a lot of factors in all of that. And we have to contend with a lot of time and space between now and then. One of the things we're going to have to contend with is very likely a global recession, which I think is already underway. A lot of the data about consumers and purchasing managers indexes and other indexes related to industrial activity and manufacturing activity are indicating that we are slipping or have slipped into a contractionary phase. Now, this always presages recessions. The other big one, and you've probably heard me talk about this before as well, is the U.S. Treasury 10-2 spread. I'm not going to go into a big explanation of that, but basically when the 2-10 spread goes negative, that has 100% of the time presaged a recession in the U.S. And it's the most negative right now that it's ever been. So the 2-10 spread is around negative 80 basis points, which means that 2-year money is more expensive than 10-year money. So I'll just give you the actual real rates we're talking about here. 10-year money right now is priced at about 3.5%, let's say. 3.58%, and 2-year money is priced at 4.39. So the short end of the curve, which is where the Fed is able to manipulate that and increase interest rates, is higher than, so 2-year money is more expensive than 10-year money, and even more expensive further than 20 or 30-year money. And again, what this has presaged 100% of the time in the U.S. and by default Australia is a recession. So we're headed down that path. We are going to have a recession in the United States, and I think we're going to have one in Australia as well. So that's a lot of stuff about interest rates, and I think rates are one of the 3 key things in the macro model that we run, which is growth, inflation, and interest rates, or growth being the direction of GDP, inflation, and interest rates. 3-factor model. So I've just talked about inflation, I've just talked about interest rates, and I'm about to talk about the economy. So the economy is really going to suck in the next probably 2 to 4 quarters. It's not going to be good. Economic activity is beginning to fall off a cliff. There was some data out of China overnight where their export volume is down something like 40%. This is just incredible. The Shanghai shipping rate, which is an index of the cost to move things around the world on ships, has just gone from COVID highs of something like $30,000 for a container, just ridiculous, down to some very low level. I don't know what it is off the top of my head, but some very low level. Again, signs that there's overcapacity in the shipping business, which means that goods aren't moving around as much. So that's not a great sign of global economic health. We continue to also have elevated oil prices. So oil is a huge input to everything. I've talked about this quite a bit over the last few years, where oil, we live in an oil-based economy, despite what anybody thinks. We're not moving away from that anytime soon. And as oil prices rise and stay elevated, and that's a function of the U.S. dollar, which I'll discuss in a moment, we will continue to see pressure in the inflation numbers toward the upside. And of course, if it costs more to fill up at the pump, people have less disposable income to spend on other things. And oil, the price of oil flows through to everything. So it increases the cost to transport goods, it increases the cost to farm things, and it increases the cost of production and manufacturing, because again, a lot of the input cost in anything, in making anything, is actually the energy component. So we don't have a good economic setup for the next couple of quarters, which again, for those of you who've been following me for a while and know the Hedgeye model that I use, it means we're in quad 4. We're going to be in quad 4 for at least the next couple of quarters because the economic data, again, it continues to deteriorate. Now, a couple of things I just thought I would touch on for you. The inflation rate in Australia, which I was sort of touching on during the interest rate discussion a few moments ago. Just this is a chart of the inflation rate in Australia. Now we had that big inflation back in the 70s, early to mid 70s, which took rates up to 17 or so percent on the inflation rate, and interest rates even higher. And a fall off of that for a number of years, and really inflation's been trending down. The RBA targets, as by their own words, targets 2 to 3% inflation. That's what they want to see. So the fact that we've ratcheted up here in the last year is a function purely of the amount of credit that's been available in the market, and that is a function of this right here. So just let me pause there for a second and just re-explain how asset prices grow. Asset prices are driven by the availability of money or liquidity in the system, and all of these policy responses, just look over the last, say, 20 years. Whenever we've had a serious stock market crash or an economic recession or whatever, we've had the Federal Reserve, we've had the Aussie Reserve Bank, European Central Bank, etc., printing money. They've been lowering interest rates and providing a lot of liquidity to the system. And one thing you'll learn about the Austrian School of Economics is they don't think that there should be a central bank at all. They disagree with that wholeheartedly. They believe that the market forces always seem to work themselves out, and that we shouldn't be influencing or trying to influence the market. Keynesians, they think the opposite. Given the history that we have had, that we've been in a 100-year Keynesian market experiment, I'm beginning to, not that I have to be convinced very hard, but I really do believe that there's a lot of merit in looking at the way the Austrians view things. Nothing's going to change anytime soon because a lot of Keynesians are the ones who are running governments and central banks at the moment. But asset price inflation is purely a function of the availability of credit. And as I mentioned, the cost of capital or the cost of credit is rising. This is going to have a deleterious effect on asset prices. So, I've had a few of you contacting me recently about buying a property, buying investment property, doing this, and I've done my best to try to talk you out of it right now, because over the course of the next year to probably 3 years, we have already seen the cost of capital has risen. That is going to not be a recipe for an inflation of asset prices, whether that be in the stock market or in other assets like property, whether it be residential or commercial. I'm not calling for a crash. I'm not saying there's going to be a crash. We've already seen prices coming down in the commercial and residential real estate markets. Will they crash in Australia? I don't know. I mean, it's a huge bubble, but our country is set up where a lot of money flows into the property sector. So are we going to have a crash? Probably not. But here's the trick, though. Not the trick even, but here's the thing to say about that. If the asset that you own isn't going to appreciate, regularly in the next couple of years in terms of the appreciation of the underlying asset, what's the point of holding it? Why not wait until the cost of capital here, pivots, like we had this point from 2004 to 2000, let's say 8 or so, where rates went from let me see if I can just grab this chart, and well, I can't actually. Sorry, it's not going to give it to me. But rates went from, let's say, somewhere in the low 4s up to the 7.5% range, and then there was a pivot, and the cost of capital started to come down. It's no coincidence that we started a big bull run in Australian real estate prices during that time. I mean, all you have to do is, if I could put a chart of Australian real estate prices and put it overlay it on this one, you'd probably see real estate going down during this period, up during this period, and then as rates came down, you'd see property prices going up all during this time, with obviously some minor fluctuations due to whatever's going on in the economy. But for the most part, we've had a huge asset price inflation since 2010 or so, when interest rates pivoted and began to cut them. So now, again, my point with all this is to say, well, we now have, we can't go lower than zero on interest rates, and we're headed higher. What effect is that going to have on the economy and asset prices? I think it's going to keep them suppressed for an extended period of time. So that's enough about the economy. Let's just quickly talk about the U.S. dollar, and then I'll wrap this up. Oh, actually, sorry, the Mises Stationary Index, Stationarity Index, which is what I was referring to a moment ago. I'm not going to go into this because I'm already at 20 minutes, so I want to try to wrap this up quickly. But one of the things about this index, which is so interesting, and it's a U.S.-centric index because it uses the total U.S. corporate equity divided by U.S. corporate net worth to get you to a number on this chart. Or on this table, and pretty much one is the benchmark. You want to be at 1 because that means U.S. equity and U.S. Corporate worth are basically equal. As this line goes up above 1, it means that U.S. equity is too expensive. It's getting too expensive. You're paying too much for equity based on the actual value or the net worth of the corporation. And if it goes below 0, which as you can see here, there are periods of time when it does do that, it means that that's when you want to pile in and buy, equities because the value of the company is lower the value of the equity is lower than the value of the company. And that's what happened during this big period in the 80s, where for any of you that have, are similarly aged to me around 50, you'd remember all the corporate raiders and all the, leverage buyouts and all this stuff that happened during the 80s. Those crazy times that just created a generation of people like me who loved the 80s and the exuberance and all the stuff going on then. It's because equities in the U.S. were so bloody cheap and people were making money hand over fist because of that. Anyway, I don't want to spend too much time on that. You can spend some time if you like. Pick up the Tao of Capital. Another great book to read is Economics in One Lesson. Hopefully that comes up correctly on the screen when you look at it. That's a book by an economist, Henry Hazlitt, who is an Austrian. I think he's passed away now, but it's a great, tight, in layman's terms, encapsulation of a lot of things, economic concepts that people get confused about that they think are good. When they're actually not, and he explains them really well. Okay, a couple of things on the U.S. dollar, and then I'm going to wrap it up. The U.S. dollar has been has had a little bit of a pullback here. It is still in a bull market, but it's had a little bit of a correction. And one of the things I point out for you guys is the correlations between the U.S. dollar, those inverse correlations, where as the dollar rises, if it's a negative correlation, it means the price of that thing falls, and vice versa. So the dollar has been declining in the last couple of weeks, primarily off of the inflation number that came out, I think, 2 Fridays ago, just before Thanksgiving, where people reveled in this inflation number, thinking, "Oh, inflation's now coming back down." And went, I think the print was something like a low 7% inflation number, and everyone's thinking, "Oh, yay, we've seen a pivot now in inflation, so that means the Fed's going to stop with the rate rises." Well, the Fed's come out and said, "Sorry, no, we're going to have to see much lower inflation from here." So that kind of put the kibosh on that, and now I think we're going to see the resumption here. We've already started to see it, the resumption of the bull market in the U.S. dollar. And as such, the inverse relationship of everything else. So the S&P 500 is going to be going down. A lot of other indices will continue their bear markets. Things like oil will keep going up. And interestingly, gold, which is probably now taking on more of that quad 4 characteristic, which is we want to own gold in quad 4. We'll probably see a bit of a pullback as well. And I'll be loading up on precious metals here, I think, in the new year as we see the dollar resume its uptrend. The higher the dollar goes, probably the lower the precious metals goes, and I'll be adding and building those positions, because as we get into a traditional quad 4 environment where we know that the Fed's policy response is going to be eventually to pivot and cut rates, that's when things like gold and the gold miners and so forth do really well. So I'm going to own them at a price. I think I've got a little bit of silver and a little bit of gold and a little bit of GDX floating around out there, but we'll be adding more to that. But in any case, the U.S. dollar is, again, had a little bit of a correction, still in a bull trend, and I think we're going to see the resumption of the dollar. A final thing that I just want to point out is volatility. We've also seen a slowdown, not a slowdown rather, but a pullback in volatility. Actually, it's probably, better to show you on this chart. Actually, I'll do that. Yeah, this chart here is great. So this is the VIX, the volatility index, since February of this year. And we've had a couple of, three actually, distinct pullbacks in volatility and then another ramp in volatility. So I don't really have to explain this chart much. I think you can figure it out. We're here at number 3. And where do you think the expectation is that we're going to go? Zoop, back up into the 30s for volatility. And when that happens, like right now we're in the chop bucket, where it's more of a trader's market. We're not quite, ensconced yet in the investable market. We won't be there for another probably 6 months at least. And we're probably going back into, I think, an elevated volatility market. It's going to mean that equities are going to struggle. And there's a lot of pain to come, and I'm reaching 25 minutes here, so I'm going to wrap this up. Thank you for bearing with this market update. Just the final thing to say about volatility is keep an eye on that, because as vol increases and goes back into the 20s, low 20s, mid 20s, high 20s, maybe into the 30s, the stock market is going to continue crashing. And by the stock market, I mean the NASDAQ, the Russell, the S&P 500, the Dow, a lot of the other components of it as well. There are some places to hide. And there are some great companies that will give us some downside protection. Consumer Staples is one great example of that. But now is not a time necessarily to be loading up on equities. It's also not a time just yet to be loading up on longer-term treasuries, even though I do own a lot of that stuff. And I've mentioned before that I was early to that trade. That's going to pay off at some point, but I will continue to add to that once we really start to see some signs that there's been a shift in the treasury market and a change. That's about enough for today. Sorry I had to put so much into this update. I didn't do one last week, and there's a lot going on this week. We do have a U.S. Fed meeting next week. I think it's on Thursday, where we get the interest rate announcement there. That could really start some fireworks in the market in the lead up and in the run into Christmas. So we'll just have to see what happens. With all that said, I will come back with probably 2 more market updates before I break for Christmas. Definitely next week when the Fed has their meeting. And in between now and then, if you have any questions about anything, please let us know. And with that, I will say good afternoon and enjoy the rest of your week. Thanks. Bye-bye.